So welcome to, I think this is our third Q&A in Brisbane. Sorry, not Brisbane, in Perth. In Perth. Done a few more in Brisbane. The purposes of these events, as some of you have heard me say, they are just largely just a value add and an opportunity to get to know the team from CFMG Capital, learn about a particular topic, sometimes investment in other areas, sometimes self-managed super fund experts. We've had demographers. Today we are going to learn all about property in Perth, which is sort of why we are here and why we're expanding into the Perth market. Not going to go overboard on all about CFMG Capital because the majority of you know plenty about us and are already invested with us. We are now sitting at over 2,500 lots controlled nationally with an end value of over $1 billion. Our monthly income fund now holds $60 million in capital, and the Land Opportunity Fund, which has been the flagship fund for 18 years now, is holding approximately $120 million. And that has been that flagship fund for a long time, and we're really, pleased to continue that fund over its 18-year period with its 100% track record of delivering the targeted returns and no investor ever losing $1 of capital. So something we're really proud of. If you're not an investor, you won't hear much more from me, but there's plenty of people in the room that sometimes the existing investors are the best salespeople. So ask them about us. We are all in on Perth. We think it's got strong fundamentals, and you'll hear more from Trent. I don't want to steal his thunder, but we're not, we're not parochial, or we're quite agnostic about where we go. So while we do spend a lot of our time in Brisbane at the moment, and that is our head office, and we're doing a lot of development there, that's because that's where the numbers tell us to go. It's not because we think Brisbane's, the best thing sliced bread. And 10 years ago, we were very heavily weighted to Melbourne, and not anytime soon, but one day we might be again. So I'll move on. I've had Trent as a guest on my podcast this week. So if you want to hear him again, you can log into the CFMG website and hear the podcast. But Trent, to the Perth locals, he's on the radio. He is the managing director of Perth Strategic Property Group, and he is a strong market commentator and property strategist, and definitely the local expert in the area. He's got a really deep knowledge of the Perth market, but also the broader Australian market and what drives people across the country. And as I said, does host his own radio show. And while I said we're not parochial, from my experience talking to Trent about property in Perth, he is quite parochial. So I'll welcome Trent up here to talk about his favourite topic, and that's Perth.
Thanks, Andrew. That is very true and very intuitive of you. You won't find a bigger fan of Perth than myself. And that's not only because I grew up here, but because all of my money is invested in Perth as well. My strategy is a little bit different to many investors, and CFMGs included, is that given I know as much as I can know about Perth, and to be frank, a lot less about the rest of the country, my strategy has always actually been to stick to what I know, which is this state, and then pick the sectors rather than the locations that hold the least risk. So at one point in time, it may be small-scale development, it may be large-scale land development, it may be childcare centres, it may be industrial warehouses, wherever I see the greater need to solve problems for society, and that is providing a supply of buildings or houses or lots. That's where I'll go, but it will stay in the area that I have the most knowledge about, and that is my beautiful home city of Perth. So I really appreciate the invitation, and you'll always find me happy to talk about this beautiful city and state. All right, I always start every conversation about property with these, I think it's three slides, pardon me, because it's important that we understand, if I can Sorry, yeah. It's important that we understand where the world sits and exactly why price growth occurs and why it doesn't. There's so much noise out there right now. Sentiment is currently overpowering the realities and fundamentals of many markets, but especially Perth's in the last couple of months. And so I want everyone in the room to get on the same page about the basics. And the basics are that the ultimate truth for price growth is demand growth over supply growth. Anyone here that did a year 10 economics course will understand that price growth only occurs when demand is growing faster than supply. And so let's break that down in a contextual way, because it's easier to say that. But what does that mean for me as someone interested in putting my money where my mouth is in property? What it means is a change in buying power, and we'll talk about what that means, to a change in stock on market. Okay. So that change in buying power and stock on market is also infected by one other thing. It's modulated by, and we can see it very, very instinctively with a thing I call a credit servicing factor. And that's essentially the way interest rates go up and down, as well as the way that banks assess your income. So for example, in 2017, the interest rate may not have moved, but they put buffer rates in to make it harder for you to get debt at the same interest rate. That had impacts on the market that impacted the outcome on price that demand and supply was controlling. Okay. Now, we can break that down further. Again, on the left side, the demand side over the supply side. Demand side is net migration growth, right? So more people plus wage growth with more money, right? More people with more money means more people can demand more, right? And on the supply side, where does supply come from? Well, it really comes from two factors. It's moderated by two factors. It's building approvals growth, and really it should be building completions growth. I should update that after 7 years of having this slide. It's actually building completions growth. And in addition to that, and we haven't really noticed this in the last 6 years, it's also mortgage stress growth, where properties will come on the market when they otherwise wouldn't have because of mortgage stress. We saw that pre-COVID in Perth in places like Baldivis, Mandurah, Midland, had massive impacts on the price outcomes there that were really determined where the market was going in that area, much more than supply of new product. And then again, as I just said, change to assessment rates, change to which is interest rates, which comes from the basis of the RBA's cash rate. And that's why we all care about the RBA's 8 cash rate decisions every year, because it has material impacts on how much the precipice, the frontier of affordability, mainly first home buyers, can pay for that next house. And that essentially defines how much growth a market gets based on its demand versus supply ratio. You could have 100 demand over 80 supply, and you'd expect to therefore see a 1.2 factor, obviously, in that space. But if that's then moderated down by a negative impact from rising interest rates, you may see no actual price growth, simply because of affordability changes in that space. All right. In the bottom corner, I've got a couple of points there that do have impacts as well. People per household. Now we'll talk about why that's important in the future, in future slides. Inflation, cost inflation has massive impacts on the replacement cost of new housing. No one's going to build a new house and if it's more expensive than buying the existing house next door, right? That is always going to be, I guess, a frontier determinant. And then perception, confidence, sentiment, having massive impacts right now on over and above with the actual fundamentals of our market. So, where can I find that information? So that's nice to know, Trent, but how do I actually have context and control over that information? Because I'd like to be able to track it. I'd like to be able to not have to call you and ask, how's it going? How do I track it? So I can tell you how I personally track it every week. We have games in my office with my team where we constantly remind each other about what these numbers looks like, so that our team can actually have context going forward too, because it actually impacts not only price, but also the amount of work in the industry for real estate agents, settlement agents, mortgage brokers, valuers, stagers, moving companies, tradies. All of that are massively impacted by the amount of transactions in the market, which is comes in here, and stock on market. as well. So these, pardon me, these should actually be swapped. Transactions should be on the left side. We just had new some new branding go in. Transactions should be on the left side. Demand. So demand is tracked by transactions, right? You can see it every week. This week we had 601 transactions. Last week we had 775 transactions. The mining boom had 800 transactions a week. We spent the last 6 years between 800 and 1,000. And pre-COVID, it was at 500, right? So our demand factor can actually be easily tracked by the amount of transactions every week. REWA publishes this every Monday at 8 a.m. You can see it every single week. 600 is the lowest number we've had all year. And that talks directly to the sentiment in your market post-budget. The supply side, apologies again, is tracked by a stock on market. REWA also shows you stock on market numbers every single week. The darkest day in our market was March 2019. And that correlated specifically with the most amount of stock on our market ever. It was 17,600 properties. A balanced market has 13,000 properties. Christmas time just passed, we had 1,800. We've now risen to 7,000, which is still just above half a balanced market in WA. And when we talk about the sentiment side, which we will continue to talk to, it's interesting to note that when the market was dropping in supply every week from 17 to 15 to 13 to 10, past 7, everyone was very excited about the Perth market and seeing the direction. It can't go any lower. We've never seen this before. It's a record. It's a record. It's a record. The second we're at 7,000 from the lowest number ever, going in from a different direction, people are starting to freak out. The reality is, in isolation, we are still in a market that has half the supply of a balanced market. Half. And if you asked me 3 years ago, what does 7,000 properties on a market means? It means massive historic boom times for Perth. So it's quite interesting to read the sentiment in the room now when the facts, the data, which is all we can really care about as a medium to long-term investor, say very different things to the headlines in the newspaper written by journalists who don't understand anything about property. And then again, daily bank updates. 8 times a year, the RBA will tell us what the cash rate is. The banks will then follow a day later when it goes up and 2 weeks later when it goes down on what the interest rates are going to be and essentially how hard or easy it is for people to pay what they have to buy a property. Okay, I just want to give a bit of global context for the next couple of slides about a couple of things. First, we're going to talk, you can see the demand side. In the top left-hand corner of our slides, I'm either going to be talking, so for your assistance, I'm either going to talk about demand or supply or the outcome of those things. Okay, so you can always track what's he on about. Well, at the moment, I'm on about demand. It's important to understand where the demand's coming from because if we're all very honest with ourselves, we know where people are coming from and where they're going. And we know that people generally, for decades in the past, whether they're Italian or Greek or Vietnamese or Chinese or Sudanese or Indian or Irish or English or Scottish, we know where most of them like to live, which is next to where their mates are, right? And so if you want to look at a micro level of Perth, you can actually start to get an idea on a number of things going forward. The first one is to understand where the migration is coming from and going towards. And we know that globally, a lot of migration is coming out of China, a lot of it's coming out of India, and a constant amount is coming out of the UK as well, and it's going to Australia. You don't have to be anything other than having your eyes open to know in Perth that those are the 3 origins of where most of the new people in our state are coming from. And therefore, let's be practical about it. Where do they like to live? Well, we know that Poms like to live in the city of Joondalup and the city of Mandurah, right? It's pretty much Little Britain up there past Joondalup. We know that Indians like to live in places like Canning Vale and anywhere up to Ellenbrook. And we know that Chinese like to live around Willerton and Rossmoyne and these sort of places. So if you know that's where the demand's going and you're specific in a very acute way about investing where the demand is actually going, then you would and then you would actually be thinking in that practical way, and then balancing it off against the supply side. Does that make sense? This is interesting. We keep hearing about the Australian dream, and we keep hearing about how it nearly isn't. It has been for decades, generations, an Australian right to own our own home, to buy our first property before we're 30, and you nearly feel embarrassed if you haven't. Yeah, it feels like if I haven't, I've done something wrong, or I'm on the wrong path, or I was let down somewhere. The irony of it is that's not the case in many sophisticated first world countries around the world. And it's not because people aren't interested in property or interested in their financial situation. It's because it's become irrelevant to many of them simply because of an outcome of the capitalist nature of the housing market around the world in Western societies. My wife is Swiss. Her sister and brother-in-law make probably $700,000 a year between them. One works at the top of a shoe company. The other one works for YouTube. They rent an apartment that we would never consider renting in for $8,000 a month, and that is a normal apartment. That is none of us in this room would be proud to show to our friends. Right? They are very well off, well-to-do people, and the reason for that is that market is about 150 years ahead of Perth's market. And that talks to the only reason why we have an opportunity to sit in this room and talk about property and making money off a company who's taking risks and expecting rewards in property, because they're not having these conversations in Switzerland, because that money was made 150 years ago, and the market's matured so much now that those opportunities don't exist. And the reason I'm suggesting that is because private investment is so important for changing and evolving and growing societies, and housing is a basic need, which is why it's relevant to our market in Perth right now. Not because it's a better idea or a human right here and not there, but simply because it's possible. When you think about someone in New York, you think about Friends and Seinfeld and Big Bang Theory. They're all 35 years old and sharing a rental, right? And they all had good jobs because 100 years ago was their opportunity to own that apartment. Now that apartment costs $10 million, right? So we're just 100 and something years behind all that, and it's our opportunity to be a part of the growth and fix problems in society. And the biggest one in Perth right now is a roof over people's heads. So if we can help fix that problem and put our money where our mouth is, we should probably expect a return on that. Okay, let's look at that in numbers. Western Australia had 66,000 people come in last year. Years before that were 75, 88, and 92,000. The year before that was about 12, and that was pre-COVID. That 92,000 was the same amount of migration that Perth had for 5 years total before it. And we've been consistently having these numbers up in that range since then, obviously moderating slightly. But what's important to remember is that, and I'll talk to this later, we only built 26,000 houses. We only built about 20-ish thousand houses. I'll get to the supply number in a sec. Last year, they can house 50,000 people. So if we had 66,000 people come in just last year, where'd the other 16,000 go? They had to share. Increased amount of people per houses as a base number. People always find a way. They find granny flats. They find rental. They find short stay accommodation. These sort of things. But what we know is that for the last 5 years straight, we have been creating a deficit of properties available based on the amount of people coming in, and we continue to do so. And the year that we eventually have a less amount of people coming in to match the capping out of supply that we've got in our state, we'll still have about a 50,000 house deficit to soak up over the next couple of years after that, if we ever can overbuild like we did in 2016. But I'll talk to that later. Inflation. Inflation is important. Inflation is mainly caused by government. It is caused by public spending from governments, mainly left-leaning, because they want to be big. They spend a lot of money on hiring more people in government and infrastructure. And what it does is it crowds out the private market, and it makes private investment more expensive. And private investment is 96% of investment in housing, in the housing space. And therefore it makes housing more expensive. And when housing is more expensive, as I said before, the established market comes with it. And that is called replacement cost theory. And so the more inflation we have, the more expensive the next new house is to build. It essentially drags the established market with it. If you think about a place like Ellenbrook, back in 2020, you could buy a 3-year-old house for $400,000. To build a house next door in the next estate, 200 grand land, 200 grand house, we're at $400,000. The second inflation started coming in post-COVID because of all the money coming through. It then started becoming $500,000 to build that house next door. So no one was building the house next door. They just bid up the established houses until it got to $500,000. And then one person starts building it at $500,000. As inflation keeps going and going, and suddenly we're spending $900,000 to buy a piece of land and build a new house in Ellenbrook. Suddenly the established market is now $900,000 to buy a 10-year-old house in Ellenbrook that only 6 years ago was $400,000. Now the reason for that is mainly inflation, driven by the fundamentals of demand and supply, and supported by cheap enough interest rates for the people looking to buy there to afford that number. Demand is also obviously impacted by rates. So as I said, the credit servicing factor, that assessment rate space, which is an outcome of interest rates and buffer rates, is probably the key modulator in the short-term space, definitely the key modulator in the short-term space on price growth up and down. You can have fundamentals that are undersupplied, as we do. You can have fundamentals that are oversupplied. But the second you see rates go up and down, they have direct impacts at the negotiating table next week at the home opens with regards to whether that, so long as there is enough demand, that house will receive price growth or not. Okay? And what we do know is that future expectations is where a lot of our decision making sit. We don't make decisions based on where we are today. We generally make decisions about our lives about where we expect them to be next year or in the next couple of years, don't we? And that is what I was talking about before with regards to the stock and market direction. This is important because it talks to whether a release valve is going to be opened on our market. And in my opinion, the first opportunity for the fairly negative national sentiment that's impacting the Perth market to have a breather and come back to our fundamentals of undersupply. Now, what you can see here is what should be the foremost informed institutions telling us where they think that is going to go. Westpac, generally the most bearish, suggesting that we've got a bit of pain with regards to the affordability of people who need mortgages the most. And the other three banks suggesting, which is where I, if you have heard me on radio or on my podcast, believe it will go, that will essentially be going sideways for the rest of the year and the first half of next year. And then as an outcome of an absolute kick in the nuts to the Sydney and Melbourne markets, the Melbourne market of which is already in the doldrums, the Sydney economy, from a multiplier effect, is going to really start hurting. And the reason for that, and the Sydney economy is half of our market, it's where the RBA makes its decisions, it's where all the politicians are, it's where most of the impact sits. So when the Sydney market needs help, or the Sydney market's overcooked, that's where interest rates go. Irrespective of where Perth's market is, whether we need rates to rise or drop, we just get the outcome. And we have to make decisions based on where we think that's going to be. So where do we think Sydney's going to be? Personally, I think Sydney's economy is in for a world of pain because so much of its market and so much of its psyche is built around its housing market. It's pretty much made every investor, sophisticated or not, rich simply by being in the market over the last 15 years. And if they can't keep taking that drug, then people start panicking. Now, what also happens, as I alluded to before, is the second you start having 30% less transactions in a market because there's less essentially investors in that market, you have less work for real estate agents, settlement agents, mortgage brokers, and building inspectors, valuers, stagers, movers, and everyone in between. That means less payroll tax, less stamp duty, which is the drug of state governments, and less GST, and less income tax. So everyone loses when there's less activity in property. And so when the Sydney market goes down, rates will drop. And whether we need those rates to drop or not and to support the Perth market, we will experience the sugar hit of that serviceability increase. Let's talk about supply. This is the Australian supply slide. You'll notice I don't have a lot of Australian slides. So I don't really like talking about the Australian market because I think it's like talking about the ASX. It's highly irrelevant to investing in BHP, for example. You can't invest in the Australian housing market. You invest in a house on a street in a suburb in an LGA. You cannot invest in the Perth median house price. So why are we talking about it? And you certainly can't invest in the Australian median house price. There isn't one. So anyway, this is a WA new housing supply slide. What it shows, pretty interestingly, I think, is that whilst we have about 40% more people in our state, we aren't even close to being able to build the amount of houses we did 10 years ago, which is what led to us having an oversupply. The second 50,000 Kiwis, which is the size of Dianella, left our state in 2016, which happened because we no longer had gas projects to build. We don't have that reality anymore. People are here to stay because Perth's the best place in the country. But what we clearly have is a reality where, and if you ask Tim Reardon, the chief economist at the HIA, or Michael McGowan, the executive director of the HIA in WA, we are hitting red line 8,000 revs per minute on our car in the property construction space. We can't build more than the line you're seeing right now. We don't have the people. We don't have the productivity. The houses are too big and too complex to build these days compared to a 3x1 in the 70s. And so we just can't fix that problem with supply. We won't get to 30,000 houses. It won't happen this decade. So therefore, we can't build for 66,000 people coming in. The only hope, if you hope the property market goes down or doesn't grow as fast, is that less people come to this state. But we also live in a state that has the highest GDP per person, has the highest GDP growth, has the highest surpluses, has the best wages other than Canberra, and the most prospects with regards to things like AUKUS. So there's a lot of reasons to argue why that won't change for a long time with regards to immigration. So if we can't build more than we're building, we aren't building enough for people coming in, and that's not going to go down, that means that prices keep going up. And they keep staying up like Sydney until we can't afford it anymore, like Sydney. And so I've been saying for 5 years now, there's no reason why Perth's house price can't get to Sydney's house price like it did in 2008 for a short period. And it won't be because Perth will overtake Sydney in the sense that it will get to $1.5 million. It will be because Sydney is on the way down and we're on the way up still. And it will be a convergence. It's very possible. I'm not saying it's a reality, but it's very possible it'll happen again. Anyone who says it can't doesn't understand basic economics. There's nothing different about Perth's market to Sydney's. There's nothing different about us. The houses we build, except they're more expensive and they take longer to build. The income we make and the loans we get, they're all the same. And there's no reason why ours can't be if we have the required situation and fundamentals. I'm not saying it's a good thing, it's just possible. While the target continues to rise towards 150,000 dwellings by now, our actual deliveries sit at 70,000 dwellings. So, yeah, we're way off when it comes to infill. And infill is I guess, half of the story when it comes to supply. Obviously, the people in this room are interested in investing in mainly urban expansion, but half of the story is supposed to be infill, and we aren't even close. Now, infill is triplexes, it's house behind a house, it's apartments, it's townhouses. We're supposed to be building 47%, which rose to 51 to try and catch up, of our houses in infill, and we're in like 20-something%. And that is because it is so hard and expensive to do infill because of local governments, because of construction costs, because of neighbours, planning realities. And it's that much easier to do urban expansion because the neighbours aren't there and the planning stuff's been sorted out years ago. So at the moment, for me, most of my money is in land development between 2 and 15 hectares spaces in as close to Perth locations as possible. Many of which are actually infill sites, because I believe in the fundamentals of Perth, and I also believe it's the least risky way to provide supply and solve that societal problem that we are educated to solve. All right, WA experience 66,000. Here you go, 20,000. I was right. So 20,000 houses about 50,000 people. And as you can see, our shortfall is now 45,000 houses. So 45,000 houses, obviously houses are just over 100,000 people. So that's how many people we are behind who are probably sharing when they otherwise wouldn't want to. So we have a long way to go when it comes to the eventual year where our immigration number gets down to about 50. We still have a deficit to catch up, which will take who knows how long to catch up. This is not a political statement, although the picture looks a little political. I just copied it off LinkedIn. But it's a reality. Since left-leaning government came in WA, we are less productive, and houses cost more because they spend more on infrastructure than right-leaning conservative governments generally will. They like to let the free market do it. Left-leaning governments like to tell you how it should be done and do it themselves, and they do it less productively, and they do it less efficiently and more expensively, and that crowds the private sector out, which makes things more expensive. And when there's less of it going around, it costs more. It's just a reality. And the reality in Perth is most likely we will have a left-leaning government obviously this term, and definitely next term, and possibly the term after, given how far back the right-leaning opposition is. And so you can't, and the point is not a political one. The point is read the room. The rule book's not going to change. The spend is not going to change. The immigration space on the federal level, most likely an Albanese government again, whether you like it or not going to change. WA, very attractive place, not going to change. Supply, can't get any more, not going to change. So what happens when all those inputs go in to a non-biased, non-emotional machine? The output is pretty obvious, I believe, to everyone. And the only reason people think it can't is because they're mean reversionists. They think what's been up must come down. You've been too good for too long, Perth. You've got to give us a crack. Sorry, that's not how it works. The reality of the numbers is essentially what determines the outcomes. So this is why we don't have an ability to bring those supply numbers up. We don't have enough tradies, and it's taking longer to therefore to build what we're doing. This is the best way I can explain it. And it's what's pretty great to see is you go back to 2013, takes about a year and a half to build a house. It's exactly when we had an oversupply, the last time those lines converged. And we are as far away from that number as you'd want to be. So if you were believing prices were going to go up or wanted them to go up. So until that number converges and we get better at building houses quicker and more of them, the supply side doesn't fix. Okay, this is the outcome. Perth's median house price essentially went backwards for 5 years. My podcast, The Perth Property Show, started on the 2nd of December, 2018. It's been 408 weeks in a row that we've run that thing. And the first episode was named, Are We Feeling the Green Shoots? And that was, that was there. And so it still took another year or so before we actually started to see prices grow, even though what we saw 4 months later, March 2019, the darkest moment in Perth's data-driven property market, 17,000 properties on the market, that's when it turned. Probably still took a year to start seeing prices grow after stock on market started coming down from its worst number ever. So it's interesting to see and the reason for that, is because the Perth market had, to be frank, about 2 years of supply surplus at that point in time to soak up with immigration. Does that make sense? So while stock market was coming down, we still had a couple of years of work to do to actually get back to a balanced market. Okay. What you note is that prices start growing around 6 months after COVID. Number of reasons for it, but a key indicator, that's when we passed a balanced market of 13,000 properties on the market. Very interesting. That number should actually be a bit higher if you index it out based on population, but it's quite an interesting correlation. Since then, we've seen what is making up for a lot of lost time, for a lot of it, where property prices were 20 to 40% lower than they were in 2015, 5 years after. And then sugar hit with East Coast investors who had the confidence, bravado, and equity to go do what they did in Melbourne and Sydney and do it to Perth. Kickstart the market, get Perth investors out of first gear. Suddenly we've got equity, a little bit less gun shy, and suddenly we start investing, upsizing and scaling into markets, especially our own market, especially when rates got as low as they got. And then you start to see the key fundamentals kick in from about 2023 of structural, critical, chronic undersupply that the whole country has never seen before. No one has seen undersupply in any state ever like we have seen in Western Australia over the last 3 years and peaking in Christmas 8 months ago. And that is why you are seeing outcomes like this. And ironically, these outcomes are still pale in comparison to some of the growth numbers Sydney has seen over the years. But somehow their market is allowed to grow more than ours, and we shouldn't expect to see similar growth, and we shouldn't have our prices equal theirs. Anyway, Perth continues to edge close to Sydney, as I said. Getting pretty close. We were at $400 and something thousand when they were at that price. And it's not a competition, but it is what it does is it reflects the truth and reality behind the performance of our state, our incomes, and the lack of performance in our ability to supply a basic need of housing to those people. Okay. So this is again an outcome in terms of price growth. What I expect to see until rates drop is that orange line, which is our line, essentially hit zero. I don't expect to see growth until whatever date it is that Michelle Bullock and her team decide rates need to drop to support the Sydney economy. At that point in time, it starts to release again that pressure valve on what is still the most undersupplied market in Australia. And by then, people have moved on. The media will have moved on to talking about something else. Dwelling prices. This one, I think, is one I wanted to reflect on with regards to a question I'm probably going to get about the impact of the budget. That convergence line here, that's it. That's essentially when John Howard introduced the capital gains discount. It was all wrapped up in the same time as the GST and all those sort of things are happening in a very reformist time. So it is a truth, a home truth, that has clearly had an impact on the sentiment, the incentive of mum and dads to be a part of solving the housing supply problem that we have. Now, when you take that away for a period of time, you most likely see that orange line start to moderate because you see 20-30% of the market across the country just go, maybe I'll go to ETFs, maybe I'll go to stocks, maybe I'll go into some sort of fund where I don't have to be so exposed with regards to my own risk profile. And then what happens if the public sector doesn't step in and provide that housing in lieu of the private sector is that rents rise because the people are still here and the people still need somewhere to live. And those people who rent are most likely renting because they don't plan on being here long or they can't afford to buy. That's the reason. That's pretty much it. So what happens when yields rise to an asset? Prices rise. And so what you'll see out of this budget is a short-term reality and story around how Chalmers has helped out the little guy, the first home buyer. But all it will be a negative speed bump on the fundamentals that have actually governed the direction of that line, which is not actually the 50% discount. It's not negative gearing. It is a society that is not able to build enough houses fast enough for the amount of people that want to live in our country. Because it's certainly not a birth rate thing. And what we know about that is when you are born, you don't need another house for 20-something years. But when you come here, you need one straight away. All right? So there's a direct relationship between immigration and the requirement for supply. So, for example, if that was packaged up with some way that they were going to efficiently, which they never would, become a state developer and fill the hole that all the investors who are pulling out to provide rental properties in this market had been filling for decades, and say, well, we're going to do it now. Think, okay, well, you've got the answer to supply and you've kicked the investors out the way and you're going to do it now. Cool. All right, there's the answer for supply. As long as you do it, then we're all, the market will be as you say it's going to. Well, they haven't, that's the bit they missed, was the bit where they're going to step in and do the hard work. And so what will happen is all of us will be spooked for a little while, then eventually the yields will get so high that even without negative gearing capital gains tax, you'll see it as worth your risk profile to invest back in property again. And then it will come down again to the fundamentals of each state competing with each other for the amount of people that want housing. And that will determine, state by state, the performance of their housing markets. Finally, the next question will probably be, well, yeah, but Trent, there's been so much growth. How much fat is there left? Well, the fat is determined by how much money we make, the rules we play by with the banks, and what's left after that with regards to servicing and the cost of living in our state. And what you can see on this one, this is facts, this is stats, is that we still have a bit to go in terms of our capital city buffers. That's the median homes price, not house price. So that obviously brings in the unit price too and brings it down. But along with Darwin and a little bit of Hobart, we've got a bit more fat left to go in terms of price growth based on current interest rates. And again, the second rates drop, that number increases because our mortgage will be less. If rates rise, that $55,000 that's left, that differential, that's left, gets smaller. And those negative numbers get bigger negative. So the interesting thing to note about that is the Sydney price. They are $580,000 over their theoretical cap. And you go, well, Trent, how the hell can people buy houses that are $580,000 higher than their theoretical cap of what the banks would give them? The Bank of Mum and Dad is the 5th biggest lender in Sydney. So equity is massive in that space. Guarantors, obviously huge. And then they're finding ways, like the New Yorkers are and have for years, and the Sydney and the London people and the Hong Kong people and the Singapore, or not Singapore, socialist government, Hong Kong people, to jump in with their mate, with their sister, with their partner, and that's how it works, right? Whereas here, we're just getting over the idea that we may have to. Okay, so that's where that sits right now, and that's why that reality is there. It's why Sydney's market is so sensitive to rate rises and more sensitive to the expectation of rate rises than anything else, because they are actually also an undersupplied market. They have more demand, given they're the biggest and most attractive state in that sense, and they also struggle to supply, but they're so expensive that that's what determines their price these days. And Perth may get to that point where our fundamentals are so strong still, but we get to that level of expense, and that will be the determinant that limits growth, but also limits downside. I think that is getting close. Here we go. Another one. And there you go. Another one on housing affordability. So when you think about a household that is a 2-income household, this is where Sydney's at. Perth still got a bit of space. Median time on market is an outcome as well of the sentiment in our market. Now, the Perth line is the yellow line. That is a normal balanced market. When you're at about 30 days, you're in a balanced market. We've been so used to this very unhealthily low first weekend, no chance to look inside the cabinets or the shed or the structural reality or come back and show mum, I can afford $850, just take it. Mate, the thing's worth $700. Just take my $850, I'm homeless. That's been Perth for the last 2 years. Now we're back in a time where a normal market that we'd all like to be in, where the cream rises to the top. The good quality stock has multiple offers, and the lower quality stock, it sits there until the seller is conditioned to meet the market. And that market, the reality of it, is segmented. Blue chip stuff has seen, in a sentiment space, a 0 to 5% pullback on the highs of April. Investor, low quality, East Coast saturated stuff, and I'm talking City of Armidale, City of Gosnells, especially, has seen 10% drop in the space of 3 or 4 months. Then you say, oh, Trent, that's falling off a cliff. It's a reset. It's a reset back to the fundamentals of that market before the 5% scheme and before rates rose. That's essentially where the market's come back to. So we don't expect a trajectory to drop 10% every 3 months, which is actually what Sydney's done. But we also don't expect Sydney to drop 10% the next 3 months, the next one. It's about finding that level based on a pull out of investors. And the more saturated your suburb is with investors, Duncraig 5%, Armidale 40%, then the more susceptible you are to less demand and therefore sellers having to meet that market of whatever's left. And that is first home buyers and local investors. Okay. And this is me talking to, again, just the holistic outcome of why there are more people coming to this state and why those people make more money than anyone else in the country by Canberra. And it's because of the performance, mainly of our fairly diversified budgets, diversified economy in the mining space. It's been resilient. Every year, the state government bets we're going to be down to $70 prudently a ton, and we haven't dropped to below 100. Our gold industry is obviously still doing well. Our rare earths is doing well. Lithium is recovering, and a key driver into the next 15 years will be AUKUS and a 25k radius around Garden Island. That excessive, stupid money will be pushed into that area to house thousands of people who are not price sensitive because they're subsidized by the defense industry, and businesses will be making a killing supporting that industry. So places that historically were nose turned up sort of places like City of Kwinana, City of Rockingham, City of Mandurah, City of Shire and Mundajong, Serpentine Jarrahdale, sorry, Mundajong, and surrounds within that 25k radius, we'll be seeing demand support that I haven't seen before based on the amenity of the area previously, which was lower than most amenity levels in our city. There will be another reason to invest there. So I wouldn't want to be investing in Melbourne anytime soon, put it that way. Perth remains one of the strongest markets. This is important to understand your downside. So if we drop 5%, we're back to the start of the year. 10%, we're back to October last year, pre the 5% deposit scheme coming in. And that's where I think a lot of the median of Perth will reset to and then continue back on its run, as I said, along that trajectory we've been going on. But it's pretty interesting to see what it looks like for places like Sydney. They haven't seen 15% drop for 25 years. It's pretty insane, isn't it? And this just talks to the amount of equity sitting in Perth's market based on the year that you purchased. So if you purchased a property, your median equity is about $750,000 if you bought in 2018. And obviously your mortgage size has to increase over those years as price rises come in too. It's pretty interesting to see the haves and have-nots have not been people who have, and this is the productivity issue the federal government has. The haves and have-nots are not people based on people's skills and the income they make from it. It's based on whether they bought property in 2018 or not. You can make $500,000 a year having not bought any property and have less net equity than someone who made 80 grand a year, is making 80 grand a year and bought a couple of properties before COVID. That's unproductive. That's the reality. That's the rule books. As long as you understand those, you play the game. Because most of us in this room are probably not writing the rules. Oh, that's me. Questions, I guess? No questions? We're waiting for the mic. There we go. No problems. Yep.
Is this on?
Hello, man.
Hey, I'm a mortgage broker. Quick question for you was, like we're seeing quite a lot of investors actually pour back into the market because now people are fire selling their investment properties.
Yeah, cool.
And they're getting good deals on them. And we're
Call
seeing
them the
obviously-
scavengers.
Yeah, but we're seeing a lot of like, as you said, like rental yields are going up, and most investors that we deal with are long-term investors. So even knowing this new government scheme was supposed to tear investors out of the market. Most investors, as you've said, have built $700,000-$800,000 in equity, are actually seeing this as a better time to create more wealth. Whereas we're seeing a lot of our first home buyers pull out of the market. So I'm just wondering if the stats are showing the same.
Stats are pretty early. So the question was, a mortgage broker in the room saying that his anecdotal evidence from his experience is that investors are coming back into the Perth market in the last few weeks. It's too early to see it in stats, right? We're probably not going to see the statistics coming through Landgate and through places like Cotality for another 2 to 3 months. But I'm hearing the same thing anecdotally. I even had one of my property managers send me a photo yesterday saying, I haven't seen this in 3 months. It was a line out the door to the road of tenants looking for a rental. So that obviously talks to where rents are going. She came in this morning and said, Trent just got a record rental price in this suburb. Now, in a market where the sentiment is, as you've heard in the news for a while, it's the last thing you'd expect to hear. So those are the early things on the ground about what's happening over the last couple of weeks. But I would pair that with saying we just had the lowest transaction number in this year happen this week. And that really concerns me in a short-term space, which is strange because we had 775 transactions, which is the highest amount in about 3 months the week before. I think the next couple of weeks will be very important to get an idea as to where exactly the short-term direction will be. But again, I really couldn't care less about the short term. I actually don't really have any views on where the rest of the year is going to go other than it's not going to do anything. So what will happen when a market goes sideways, when the Perth market goes sideways, and let's say the Perth market makes 0% for the next 6 months, that means half the suburbs were negative and half were positive. And we can, the half that are positive are the ones that, if you put 100 hands up in this room about where you want to live, it'd be those ones. Cool. Don't all come at once.
I've got one just from related to that question, and I'm told we don't have to repeat the question. Sorry. So,
Oh, cool.
just to comment, fire selling investment properties. What if you already own it? Why would you be fire selling it when the?
It's a sentiment thing, Andrew. Like, this is the scariest time in property since COVID, has a headline, and the national media is all over it. And as always, when Perth's doing well, we don't hear about it. When the Australian market's doing well or doing poorly, it's the Australian market. When the Sydney market, I should say, it's the Australian market that's doing well or doing poorly. And so we read the same newspapers. We read news.com.au, we read Domain, and it's the Australian market's done this. And because we believe we're Australians, we take that on face value and say, well, we must be doing the same, right? And so there's a lot of fear that's come out in the last few weeks. And the irony is in Western Australia, nearly no one is negatively geared because our rents have risen by 90% in the last 6 years. You're only negatively geared if you bought an expensive Western suburbs property in the last year or two and you don't need it anyway. So like, why do we care about negative gearing? And it should never be the thing that, we're investing for anyway. If you're negatively geared, it means getting a 30% rebate on the money you lost last year. So if you lost 10 grand because your expenses were higher than your rent, then you get 3 grand back. I mean, that's a crap investment. Unless you made 100 grand in capital growth that year. And then you go, well, that was why I was doing it. But still, there is an industry of property spruikers out there that, pardon me for saying it, would bring you to rooms like this and speak about their products, which is the point. Andrew doesn't speak about his products in rooms like this. Try and get you sold into places that are no good, that you've never been to, that you've never heard of, and that sits there for 10 years doing nothing, right? And they sell you on negative gearing. And so there's still a culture out there where your mum and dad said, oh, make sure you're negatively geared. It's like, mate, why would I want to lose money every year? But there's still an industry that talks to that and spruiks that. So hopefully this starts to remind people that when the rug's taken away from them, they realize that they never needed it in the first place. Do you want to do the mic just for everyone else?
Should we still be investing in our rental properties, like still purchasing and getting them? Because the way everyone's talking, they're telling us to sell them.
Well, that's right.
So
I think I could spend 40 minutes telling you why investing in an asset in Western Australia that is a good idea, probably at this point in time, and where the risks are as well. And all I'd suggest is in the last 5 years, you could buy anything with no context, which is why a lot of East Coast investors think they're really smart in doing it, through a buyer's agent and make hundreds of thousands of dollars. We just saw it, right? But in a normal market, there is a level of prudence that needs to occur and research. And that's where good buyer's agents come to the fore. It's where good property investors come to the fore. And that's when you understand where blue chip suburbs are, where that may not have the same upside growth, but they have far more protection on the downside. And the suburbs like that might be, are you a Perth girl?
No.
Where are you from? Bustleton. Well, you might have heard of places like Wembley Downs or Duncraig, right? These are suburbs that in the downturn didn't lose anything because they're 90+% owner occupiers. Those guys love their suburb like I love Perth. And why would they move? Even if they made more money, they wouldn't move. And so they didn't sell. And markets only drop when sellers need to sell more than buyers need to buy. But that's not the reality for markets that are heavily tied to investors, and especially investors that don't care for the fabric of those suburbs. And those are the ones that don't live near them. And especially when they're impacted by their own markets in different states, they'll pull their money regardless of whether that suburb is doing well or not. And that's what we're seeing. When the East Coast is struggling, you essentially pull the doors closed and protect what you've got, right? And that includes, I'll take my money out of Perth, thanks for coming, I'm putting it into my mortgage back in Melbourne. And so that's where obviously you see the massive spikes, Camillo making 140%, tripling their value in the space of 4 years, when no one in Perth would go, that's a great place to invest. It's one of the bottom 10 worst suburbs in Perth, right? But it had the highest growth of the last 3 years because buyer's agents said rental yields, people making 12 grand a year in the rent, right? And they essentially bid that all up, and that's what creates the capital gains. The second those investors come out again, the capital gains start becoming negative in suburbs that we should never have wanted to invest in the first place as locals. But you watch the story happen from afar and don't get jealous when you're not the one making 140% in 3 years.
Oh, yeah, well, you invest way more.
There you go. Look, Bustleton's a great place to live and has fantastic fundamentals for the future, given the airport and the tourism space down there. Colley's doing well too, yeah, and it's an outcome of also of industry, lithium, those sort of places too. Any other questions?
I've got another one.
Go for it.
So when I was asking the question about the fire sale and the negative sentiments, obviously what we're saying that's driving it. Do we think then that herd mentality or those spruikers that get people in a room, as you said, given that all those benefits are still available to them in new housing, that it's going to have a huge impact on that market?
Think about that. You'd think so, wouldn't you? But the reality is, I get data every week on land sales around the state from all the land developers. It's just part of my purview. And in the northern corridor between Caversham and Ellenbrook, or Caversham and Bullsbrook, I should say, last July 25, they sold 220 lots that month. Everyone just tells each other what they were buying, so they sort of know what they're up to. This July, a month and a half after the budget, they sold 120. Right? So you'd expect that if all of that, if the only opportunity left for the tax benefits is in new supply and Perth isn't doing any infill, then it would go, we're all buying out there now. And actually, there was pretty much a 50% drop in that time because of nothing to do with fundamentals or tax sentiment. That's all it was. The least informed people were generally the people who buy that product, being the most skittish about the headlines. And then eventually what will happen is that will just go back to fundamentals once we stop talking about all this. And the fundamentals will come down to, in that corridor versus the south corridor and the southwest and the northwest corridor, which ones of those suburbs have the most amenity to offer, and that will be what determines whether they perform better than the other suburbs in those corridors versus the established inner suburbs of Perth as well. Balanced off by how much it costs to do that versus buying. Now, a fantastic opportunity in Perth, given that there has been a pull out in investors, is to actually own investment property in the remaining investment properties in the inner suburbs of Perth, because they're not going to be making any more of them. Be far less people incentivized through the headlines to go and buy an investment property that's established. And we know the established properties generally have more amenity. And if you can, for example, invest in a property that holds the land to do maybe a triplex development where you can create the new supply that has the negative gearing and capital gains benefits for the person who buys it in the suburbs where it has more amenity, well, that pretty much ticks every single box, doesn't it? So that's pretty cool. All right. Andrew, is that it?
That's it from me. If
Right,
anyone
yeah.
else has got one.
Oh, here we go. It keeps going.
Hi. So I've noticed in the last year, over East investors have dropped off quite significantly, as it were, for the previous many years. Do you ever see the Perth market getting back into that area of a steady flow of over East investors?
That's a really, really good question. There's a couple of factors. First, as I said before, to invest in suburbs or states outside of your own, you need to have confidence that your house is in order. And so until we stop seeing negative outcomes in the East Coast, I don't expect people to be investing too much in places they haven't been before. Secondly, Brisbane's market is still doing well. And if I was a Sydney or a Melbourne investor, I'd probably be investing in a market that I'm a bit closer to, given that Brisbane's market is doing as well as, and is expected to do as well as Perth's market, right? So just thinking about that risk profile reality for the herd mentality. However, there will always be fundamentals and I guess supply lines with buyers agents where they essentially first and foremost want to be paid for. And so the opportunities that they can find around the country that they can then pass on to a buyer, that client of theirs, they're fairly agnostic about. And so if the truth continues to be that Perth is the best or the safest place to put your money for what they focus on, which is rental yield, whether for good reasons or not, versus any other state, then they've got to sell something. And if they can't sell their own states, which they haven't been able to do for the last couple of years, especially in Melbourne, then they're going to keep pushing that. However, I think it will be a very long time before we see the amount of pressure we saw from the East Coast again. Not to say it won't be there, it's very hard to imagine it being there again in a time we can foresee. So it will come down to the fundamentals of our own money and the own equity we have from the growth we've had over the last few years and our own reinvestment into our own suburbs based on what we know about them. And then the truth starts to come out a bit more about which suburbs have amenity and which ones have less.
I know you're hungry, but I do have one more question now.
I'm starving.
Just thinking, just as you were talking, this move to sort of grandfather the negative gearing and the CGT discounts in new property, probably the biggest feedback that comes from the property industry that is ignored by government about controlling housing affordability is to increase supply. And Blind Freddy can see that's how you slow the growth and, obviously get supply up to meet demand. Do you think they've accidentally or inadvertently suggested that they're trying to drive buyers to increase that supply, or do you think it's just a coincidence?
I wouldn't give a lot of credit to this government, to be honest. I genuinely don't think they had decided what they were doing until like 3 days before they announced it. And I think what they decided they were going to do was based on consultation with the Greens about what they could get through, which is why we saw the SMSF stuff come out the last second, because the Greens flipped it on its head, which impacts 1% of the market and a lot of mortgage brokers and spruikers, actually, because that's where, if you want to find a spruiker, look at an SMSF investment channel. So, yeah. The reality is I genuinely don't think the decision makers in that government have an actual grasp over the property market. Remember, these people are not professionals in property. They're not really professionals in markets or economics. Yeah, they just they're guys who are patriotic about their country for the most part. Didn't have a job that paid them better than what they get paid, and are happy to get cop the criticism for the profile. And they make the best decisions they can based on the information they get from overpaid bureaucrats who are often ill-informed about the market because they've worked in government the whole time anyway. So that is a reality you get when we get these policies, and often they just are always Frankensteined because they never end up being what they want. If you ask Albanese truthfully, what would you have done? There's no way he would have grandfathered the CGT stuff. He would have done rip the Band-Aid, but he knew that would have been one hill too far, and it would put himself way too close to not getting re-elected in a couple of years with regards to broken promises. So he wanted to keep half the people happy and other half the people happy from the first home buyer space, and then essentially just made everyone unhappy at the end of the day because he doesn't understand the economics of what they're actually trying to achieve. So yeah, most of it's probably going to backfire. Already has. Cool. Thank you very much.